Americans now owe 1.21 trillion on their credit cards. That's more than the GDP of Mexico. And the scariest part? Delinquency rates are climbing faster than before 2008. This isn't a personal problem anymore, it's an economic one. Let's start with what's actually happening. Credit card debt just hit an all-time high. Average interest rates are sitting above 24%. And for the first time in over a decade, more people are only making minimum payments, which, if you do the math, means some will pay off a $5,000 balance for the next 17 years. Let that sink in for a second. A single purchase, still being paid off, almost 2 decades later. That's the trap high-interest debt creates. And right now, more Americans are stepping into it. So, how did we get here? Now, debt itself isn't new. People have always borrowed money for houses, for cars, for school. But credit card debt is different. It's the most expensive debt most people will ever carry, and it's the easiest to fall into without even noticing. A coffee here, a grocery run there, none of it feels like debt in the moment. It just feels like living until the bill arrives, and the number is bigger than expected. That's how it starts for millions of people. Here's where it gets uncomfortable. Back in 2008, the crisis wasn't credit cards, it was mortgages. Millions of people couldn't pay their home loans. Banks collapsed. The whole economy nearly went with it. But analysts are now flagging something similar. Subprime borrowers, people with weaker credit, are falling behind on payments, at rates we haven't seen since the financial crisis. It's not identical, but the warning signs rhyme, and that's worth paying attention to. But this isn't hitting everyone equally. Wealthier households mostly paid down their pandemic savings and are fine. It's lower and middle-income Americans who relied on credit cards to cover rising grocery costs and rising rent who are getting squeezed the hardest. Picture 2 people. 1, a software engineer earning 6 figures. 2, a retail worker earning minimum wage. Both used their credit card during inflation. One barely noticed the bill. The other is now choosing between rent and minimum payments. Same economy, 2 very different realities. And that gap is widening. Banks aren't panicking yet, but they're being careful. Many have quietly tightened lending standards, meaning it's now harder to get approved for a new card or a credit limit increase, which, ironically, can make the squeeze even worse. For people who need short-term cash flow, it's a strange trap. The people who need credit most are the ones now getting cut off from it, and that has ripple effects of its own. Consumer spending drives about 70% of the US economy. So, when a big chunk of consumers are maxed out and paying 24% interest just to stay afloat, they eventually have to cut back on eating out, on shopping, on vacations. And when spending slows, growth slows with it. Businesses feel it first. Fewer customers, less hiring, a slower economy for everyone. So, is this 2008 all over again? Not exactly. Banks are in better shape. Mortgages aren't the problem this time. But 1.21 trillion in high-interest debt, sitting on the backs of people, least able to absorb a shock, is exactly the kind of quiet warning sign that's easy to miss until it isn't. If you want to actually understand where your money's going before it becomes a crisis of your own, that's exactly what this channel is for. Subscribe. The next video breaks down how to spot these signs early